The average American at 45 has $313,220 invested. That's the number every financial media outlet prints. Here's the thing. That number describes almost nobody watching this video. The median, the number that describes the actual middle of the actual distribution, is $115,000. And if you're in the 45 to 54 bracket and you feel behind, there's a very specific reason. You're not behind the average. You're behind the plan. And nobody has actually shown you what the plan requires. I'm going to show you that today. I'm also going to show you the one piece of math that changes the entire retirement conversation for people in their 40s, because it has nothing to do with how much you've saved. It has everything to do with how many more years you'll actually be allowed to save. Let's get into it. Here's the honest framing of what this video is about. The average retirement savings number at 45 is a useful piece of data, but it's been presented to you in a way that makes it essentially useless for planning. Average figures are calculated by adding up the total retirement savings of all savers and dividing by the number of people. A relatively small number of high balance accounts can pull the average upward, so it may not reflect what most people have saved. Median balances show the midpoint, meaning half of savers have more and half have less, which may better reflect typical retirement savings. You've probably seen headlines about the average and felt either relieved or anxious depending on where you are. Both reactions were based on the wrong number. The central metaphor I want you to hold on to for this entire video is this. The average is a group photo. The median is your mirror. The group photo has celebrities in it. The mirror shows you exactly what you've got. And the benchmark, the number fidelity actually tells you to hit, is the door you're trying to reach. We're going to talk about the group photo, the mirror, and the door. And somewhere between those three things, you're going to figure out exactly where you stand. Let me start with what I'm going to call the group photo problem. And I want to be really specific here, because there are actually multiple layers to why the numbers are misleading. Americans in their 40s have an average retirement savings balance of $593,109. The median is $220,919. That's one data source, Empower, which aggregates across all retirement account types. The Federal Reserve data tells a different story. The average household retirement savings for ages 45 to 54 is $313,220. The median is $115,000. About 62% of households headed by someone aged 45 to 54 have retirement holdings at all. Stop right there. 62%. That means roughly 38% of households in that age bracket have nothing, zero. So when the median is $115,000, that median is already drawn from a pool that excludes more than a third of the age group. The real middle of everyone, including the people with zero, is dramatically lower. This is not a small statistical footnote. This is the architecture of the number. When you read median retirement savings at 45 is $115,000, that doesn't mean most 45-year-olds have $115,000. It means among the households in that age range that have any retirement savings at all, the midpoint is $115,000. The broader population looks worse. Here's the mirror. Over half of American households, 54%, report having no dedicated retirement savings, according to the Federal Reserve's Survey of Consumer Finances. 54%. Majority, no savings. And just 42% of those aged 45 to 59 say they feel prepared for retirement. That's at 45. These are people in their supposed prime earnings years, feeling unprepared. There's a reason for that, and it's not laziness. I'll show you exactly what's happening to that group in a few minutes. But first, I need to explain the door. The door is the Fidelity benchmark, and the door is a lot further than the mirror suggests. Using Fidelity's guidelines, you should aim to save 1 times your salary by age 30, 3 times your pay by age 40, 6 times by 50, 8 times by 60, and 10 times by age 67. That's the door. Now let's look at what salary we're applying this formula to. Median household income rises with career progression, peaks in the 45 to 54 age bracket, and then falls as workers approach and enter retirement. Households headed by someone aged 45 to 54 had the highest median income at $116,800 in 2024. That's a household number. For individuals, The median salary of 45 to 54-year-olds is $71,604 per year. Let's do the math. You're 45, you make the median wage. Fidelity's benchmark at the midpoint between the 3 times at 40 and 6 times at 50 rule says you should be sitting at roughly 4 to 4.5 times your salary. 4 times $71,600 is $286,400. 4.5 times is $322,000. Let's call the target approximately $300,000 as a reasonable midpoint benchmark. The actual median person in that age range has $115,000. That's a gap of roughly $185,000. Not a small rounding error, not a couple of months behind. $185,000 in compounding growth that isn't happening. And here's the part that really doesn't land until you run the numbers yourself. $10,000 invested at age 30 with a 7% return grows to roughly $106,000 by age 65. If you wait until age 45 to invest that same $10,000, it only grows to about $38,000. The same money, the same market, a 15-year difference. The dollar at 45 is worth about 36 cents compared to the dollar at 30 in terms of what it becomes at retirement. That's not an argument to panic, it's an argument to be precise. Because the precise point of being at 45 is that you still have 20 plus years, but you've burned through the period where compounding does the heaviest lifting. From here, the behavior has to carry more weight. By the way, if you like what you're hearing, hit subscribe. Otherwise, the algorithm tends to bury this kind of channel, and finding us again after this video will require more effort than it should. Stay with me, because this next part is where I want to introduce the subplot that's going to run through the rest of this video. I'm calling it the invisible countdown. Everyone at 45 is working with an assumption. I have roughly 20 more years to save. That assumption is doing a lot of heavy lifting in every calculation you've ever made. And there's very strong evidence that for a majority of Americans, it's wrong. I'll come back to exactly how wrong in a few minutes. But I need you to hold that thought because it changes everything about what the numbers mean. Now let's talk about what I call the second layer of the group photo problem, the one that never shows up in the average versus median conversation. The average balance for savers who've been investing in the same 401k continuously for 15 years was $617,600. And $465,000 for those saving for 10 straight years, according to Fidelity's fourth quarter 2025 data. Read that twice. 15 years of consistent contributions produces an average of $617,600. The overall average for all participants is $146,400. The gap between the consistent 15-year saver and the average saver is almost $500,000. That's the compounding premium. That's what behavioral consistency is worth, monetized in real dollars. The person dragging down the average isn't someone who invested poorly. It's someone who invested intermittently, who contributed when things felt good, stopped during the 2008 financial crisis, rolled over to nothing when they switched jobs, took a hardship withdrawal when the car broke down. The nationwide median 401k balance in 2024 was $38,176 against an average of $148,153. That nearly fourfold gap shows why averages can sometimes feel out of reach. 4 times. The average is 4 times the median. When you read a headline that says Americans have $148,000 in their 401k, what it should say is a small number of people with large, uninterrupted balances are pulling the average up by a factor of 4. You think the problem is that you haven't saved enough. But actually the problem is that the system is designed for intermittent people and then measures itself against the outcomes of consistent people. You're not comparing yourself to yourself 20 years ago, continuously invested. You're comparing yourself to the guy on the cover of Kiplinger who maxed out every year since 22. That's a category error. It's like comparing your 5-kilometer time to a marathon runner's average pace and concluding you're out of shape. Here's a quick thought experiment. Think about the number of times between age 25 and today that something caused you to either pause or reduce contributions. A job change, a layoff, A kid, a medical bill, a divorce, a bad year. About 3 in 5 American workers, 58%, say their retirement savings are behind where they should be. Of those, 37% say they're significantly behind, while 21% say they're slightly behind. Nearly 60%. That's not a minority of people making poor decisions. That's the typical experience of working in America over a 30-year career with all the interruptions life brings. The question isn't why did you fall behind? The question is, given where you are right now, what does the math actually require? And is there a path? Let me now set up the part of this video where the standard advice completely falls apart. And I want to be fair here. This isn't about individual financial advisors being incompetent. It's about the structural incentive problem embedded in how most retirement planning conversations are structured. Here is the part that never makes it into a standard retirement calculator. Knowing where you stand relative to a benchmark and actually building a framework around that gap are two completely different things. I've had access to these numbers for years. I ran a business for over a decade, surrounded by accountants and fiscal lawyers who explained exactly how money moves inside different tax structures. And I still found myself needing to translate raw data into a system, not just a spreadsheet, but a decision framework that tells you what to do when the market drops 30%, when you're thinking about taking Social Security at 62, when you need to know whether your withdrawal rate will hold up over a 30-year retirement. That's why I built the Exit Code. It's a digital book, 8 chapters of pure retirement research, no filler, built on 50 years of actual data. It addresses things like the 4% withdrawal trap, which sounds safe until you stress test it against actual historical sequence of return scenarios. It also covers the 58% rule, which is the statistical reality that more than half of workers in their 50s are pushed out of their jobs involuntarily before they're financially ready, and what kind of buffer you need to survive that without derailing your retirement entirely. These are not opinion-based frameworks. They're mathematical ones, built on data that exists but isn't typically organized in a way that's useful to a regular person trying to make a decision. You can get it for less than a dinner out through the link in the description. If you're at 45 and serious about using the next 20 years, well, it's the most time-efficient thing you can read. Now let's get back into the escalation, because this is where I want to bring in the invisible countdown. Here is the thing that will reframe everything. The entire conversation about retirement savings at 45 assumes you have 20 plus years to save. Your plan depends on that runway. Your projected balance at 67 assumes a steady income and continuous contributions until then. And the data says that assumption is, for the majority of Americans, incorrect. The most important insight from retirement timing research is that the majority of retirements are involuntary. Health problems, layoffs, and caregiving responsibilities together account for roughly 59% of retirements, meaning fewer than half of Americans actually retire on their own schedule. Workers who plan to work until 67 or 70 but are forced out at 62 due to health or job loss face years of unplanned early retirement without adequate savings. Let that land for a second. You are not a reliable narrator of your own retirement timeline. The plan you're building right now assumes you will work until 65 or 67. More than half of Americans don't get to execute that plan. Not because they quit, because they were pushed. More than half of all workers age 50 and older lost their long-held jobs because they were laid off or otherwise forced to leave involuntarily. The research suggests that many older workers will encounter unexpected financial setbacks during the period when saving and planning for retirement is most important. And here's the punch. 28% of stable, long-time employees sustain at least one damaging layoff by their employers between turning 50 and leaving work for retirement. These aren't people who were struggling at their jobs. These were long-term, full-time employees, stable, tenured. And still, more than 1 in 4 got laid off during their 50s. The impact continues into retirement, with median income in households that experience an involuntary job loss being 14% lower than for those who did not, even though the two groups had nearly identical earning levels before unemployment. 14% lower retirement income, permanently, because you got laid off at 53 instead of retiring at 67 on your own terms. Now think about what this means for the person watching this at 45 who has $115,000 saved. The plan says, I'll work until 67, contribute aggressively for 22 more years, and get to a comfortable number. That's a perfectly reasonable plan. It is also the plan that 59% of workers never get to execute. The real risk at 45 isn't the stock market, it's the labor market. And I don't see a lot of retirement calculators with a field that says, what if you get laid off at 53 and it takes 18 months to find a comparable job? There's a story I want to tell here. There was a guy, let's call him David, an operations director at a mid-sized manufacturing company, 54 years old, been there 19 years, good salary, solid 401k. The company restructures. His position is eliminated. He's not fired. He's made redundant. He files for unemployment. The job search takes 2 years. He ends up in a role paying 30% less. He claims Social Security at 62 because he can't not. He gets a permanently reduced benefit for the rest of his life. His retirement income is 18% lower than it would have been if he'd worked until 67 as planned. His $400,000 retirement projection became $280,000, largely because the 2 years of no contributions and early Social Security claiming created a cascading effect that compounding can't fix backwards. He didn't make a single bad investment decision. He just made a plan that relied on something he couldn't control. This is a real pattern. It's not rare. The 60% who don't get to retire on their schedule aren't people who failed to plan. They're people who planned assuming they had more control than the data shows they have. This is where it gets really interesting, because this doesn't mean save everything aggressively and pray. It means the composition of your savings matters more than the total. A person with $250,000 in a well-structured mix of accounts, with a year of liquid reserves and minimal high-interest debt, is in a better position than a person with $350,000 locked in a single 401k with a big mortgage payment and no buffer. The total is one signal. The structure is the real one. And here's the comedic cutaway I need to give you before we keep going, because otherwise this video turns into a horror movie. Imagine two people at a financial planning seminar. The advisor shows a slide about the 4% withdrawal rule. The first person leans over and whispers, "I've been using the 4% rule since 2019. I'm totally set." The second person asks, "Is that the rule where you withdraw 4% per year adjusted for inflation?" The advisor says, "Yes, it's a robust framework." First person whispers again, "My advisor told me the same thing in 2006. The second person, "And?" The first, "The market dropped 40% the year I retired. Do the math." That's it. That's the whole story. Sequence of returns risk is real. It's specific to when you retire. And no one in a standard financial planning conversation warns you about it until it's already too late. Now you're asking yourself, okay, so given all of this, the real median numbers, the gap to the benchmark, the involuntary retirement risk, the structure, question, what should a 45-year-old actually do? Not generically, specifically. Let me build a framework. I'll call it 3 levels of financial reality at 45, because this is what I actually look at when I assess where someone stands. Level 1 is what I call the triage number. This is the number you need to be honest about before any other planning conversation starts. Do you have more or less than 4 times your current individual salary saved across all accounts? Not household income, your income. Fidelity's milestone says 3 times your salary by 40 and 6 times by 50. At 45, 4 times is a reasonable middle ground. If your salary is $71,000, the triage line is $284,000. For the 45 to 54 bracket, the average household retirement savings is $313,220, and the median is $115,000. Most people reading this are below the triage line. That's the starting point, not a source of shame, a number to work with. Level 2 is what I call the structural audit. This is about composition, not total. 4 questions. 1, do you have at least 1 year of living expenses in liquid, accessible savings separate from your retirement accounts? 2, do you have a high interest debt situation eating contribution capacity? 3, are you capturing your full employer match? An employer match is an immediate 100% return. Turning down an employer match to pay down a 5% mortgage is a bad trade. 4, are you paying advisory fees above 0.5%? Eliminating a 1% advisor fee could save over $1 million across 3 decades on a reasonably large portfolio. That is not a rounding error. That is a vacation home. Level 3 is the velocity question. What is your current annual contribution rate? And what does the math say about where you arrive? The average total savings rate, employee plus employer, reached 14.3% in the first quarter of 2025, the highest on record. But you don't want to be average. The consistent 15-year savers at Fidelity, who ended up with $617,600. Those are the people who stayed in through the turbulence, didn't raid the account, and kept increasing contributions when income increased. Behavioral economists designed the save more tomorrow approach, increasing savings rates by 1% each year when you get a raise, and those who followed it effectively tripled their savings rates. Increasing your contribution from 5% to 6% on a $125,000 salary adds a painless $104 a month, yet can grow a $1,000 starting balance to $333,000 in 20 years. Now, I want to address the Gen X specific situation because the people most likely watching this aren't just 45-year-olds in the abstract. They're members of the most financially squeezed generation in recent memory. When broken down by generation, Gen Xers are the least financially prepared generation for retirement by nearly every measure, according to a research paper by Alliance's Retirement Income Institute. This is the generation that entered the workforce when pensions were disappearing, navigated the dot-com crash in their late 20s, the 2008 financial crisis in their late 30s, and now sits at 45 to 60, watching their retirement window close while supporting 2 generations simultaneously. As Jeff Sipple, Northwestern Mutual's Chief Strategy Officer, put it, many Gen Xers are juggling responsibilities on both ends, supporting aging parents while still helping their children. They're also the first generation to truly feel the impact of the move from defined benefit plans to defined contribution plans. Here's the sandwich generation data, and it's pretty brutal. 1 in 4 Americans now fit the sandwich generation profile, with nearly half of millennials, 46%, and almost 1/5 of Gen Xers, 18%, juggling dual caregiving roles. And the impact on retirement planning is pronounced. 70% report that caring for both children and parents has significantly affected their retirement plans. And 59% say they have reduced or stopped contributing to their retirement savings accounts due to these responsibilities. Stopped contributing, not slowed down, stopped, during the exact years where the remaining compounding runway is most valuable. There's a term for what happens to a portfolio when you pause contributions for 2 or 3 years in your mid-40s, the $200,000 ghost. That's roughly what a 3-year contribution pause costs in eventual compounding value, depending on your trajectory. Not the contributions themselves, the growth those contributions would have generated between now and retirement. It's money that never exists. It's invisible. And it's the cost no one puts on the ledger when a Gen Xer writes a check to put a parent in assisted living. The second comedic cutaway, and I need this to lower the blood pressure a bit before we close. A 40-something guy at his financial advisor's office. The advisor says, based on your current savings rate and Social Security, you'll be comfortable. The guy says, define comfortable. The advisor says, you'll be able to cover your essential expenses. The guy says, what about my non-essential expenses, like food at restaurants and the occasional vacation? The advisor says, those might require some adjustment. The guy says, so you mean I retire and start eating at home every night while looking at photos of my previous vacations? The advisor says, think of it as simplifying. The guy nods slowly. I'm going to need a second opinion. That's not a bit. That's the story inside about 40% of retirement planning conversations. Now I want to run the mini case study because this is where the abstract numbers become a real thing you can look at and say, yes, that's me, or no, that's not me, and here's where I diverge. Meet Marcus. He's 45. He's been working as a project manager for 18 years. He makes $73,000 a year. His household income with his wife is about $115,000. He has a 401k with his employer where he's been contributing 6%, just enough to capture the full match for the past 12 years. He had a couple of job gaps in his early 30s, lost about 2 years of contributions. He also has a Roth IRA he set up in 2014, but has only intermittently funded. Combined accounts, approximately $160,000. That puts him above the median for his age group, but below the Fidelity benchmark for 4 times his salary, which would be $292,000. Here's his actual problem. His current trajectory, at 6% contributions with a 7% return and no behavior changes, has him reaching approximately $560,000 by 67. That sounds like a lot. Against a $1.46 million target, the magic number Americans think they need to retire comfortably in 2026, it's about 38 cents on the dollar. His wife has a similar trajectory. Combined, they'd have about 1.1 million, which is close to the target but leaves no margin for a down market sequence in the first few years of retirement, no margin for healthcare before Medicare at 65, and no room for the possibility that one of them doesn't make it to 67 still employed. His lever is contribution rate. If Marcus raises his contribution from 6% to 12%, still well within the contribution limit, and redirects his next 3 raises into that account before touching lifestyle spending, he arrives at approximately $800,000 at 67 rather than $560,000. That's $240,000 in compounding difference from a behavioral decision he makes this year. He doesn't need to pick better stocks. He doesn't need a more sophisticated portfolio. He needs to change one number and not change it back. His second lever is structure. He has no liquid buffer. If Marcus gets laid off at 52, remember, 28% of stable employees sustain at least one damaging layoff between 50 and retirement. He has no liquid runway, and he starts either withdrawing from retirement accounts with penalties or taking emergency debt. If he builds 18 months of living expenses and accessible savings over the next 3 years, that isn't a drag on his long-term growth. It's a defense against being forced to crystallize losses at the worst possible moment. His third lever is fees. He's in a target date fund inside his company plan with an expense ratio of 0.9%. He hasn't checked in 2 years. Switching from a 1% expense ratio to 0.10% could result in an extra $186,877 in retirement savings over the course of a career-length timeline, a 0.9 difference. That's the cost of never reading the fine print. Marcus isn't in crisis, but Marcus is also not on a path that ends well without making specific adjustments before he's 50. The adjustments are available. They're not exotic. They're entirely about behavior and structure. And they're available until they're not, because the compounding runway closes whether you use it or not. Now let me bring in the bigger picture. The data point I think matters most at the macro level, and why the standard advice machine keeps getting this wrong. Retirement assets accounted for 34% of all household financial holdings in the United States as of December 2025. The $49.1 trillion national nest egg grew by $3.3 trillion from the third quarter of 2025. $49 trillion. The overall system is not small, but the distribution of that $49 trillion is intensely concentrated. In 2022, about 46% of households reported any savings in retirement accounts. 26% had saved more than $100,000, and 9% had more than $500,000. 9%. 1 in 11 households has $500,000 or more in retirement savings. The majority of that $49 trillion sits in a relatively small number of accounts at the top of the distribution. When the average looks good, it's because of them. The financial industry has a structural incentive to let you believe the average is a reasonable reference point. A healthy-looking average attracts assets under management. A healthy-looking average keeps you in the system. An industry that managed its communications around the median would be confronting a very uncomfortable conversation about what the typical American's retirement actually looks like. And that conversation doesn't sell managed funds. I'm not being conspiratorial about this. The incentives are just what they are. Financial advisors get paid a percentage of assets under management. A 1% management fee on a $500,000 portfolio equals $5,000 annually, regardless of performance. The advisor who keeps you in a moderately expensive, actively managed fund is not malicious. They're just operating inside a fee structure that, compounded over decades, works against you more than it helps. In the long term, very few funds beat the market. Morningstar data shows only 3% of funds beat the equivalent index over 15 years. 3%. For the other 97% of actively managed funds, you're paying for underperformance relative to a low-cost index fund that costs 1/10 as much. The takeaway here isn't to never use a financial advisor. It's to understand what you're paying for and what the data says about whether you're getting it. Here is the kicker. The median retirement savings for those aged 55 to 64, the people who are just 10 years from the standard retirement age, is $185,000, which is far below the $1.46 million magic number. The people who are closest to retirement, who have presumably been building for 40 plus years, are sitting on $185,000 at the median, not $185,000 in a 401k. $185,000 across all retirement accounts. And 1 in 5 married retired couples and 45% of single retirees depend on Social Security benefits for more than 90% of their income in retirement. 90%. Not a significant portion. 90% of income from a program designed to replace 40% of pre-retirement income. That gap, the missing 50% of living expenses, is what happens when a decade of "I'll catch up later" compounds into a reality at 65, where there is no later. The 3 things I want you to take from this video that are specific and non-generic. First, run the mirror number, not the group photo. The relevant benchmark for you is 4 times your individual current salary by age 45, working toward 6 times by 50. Not the national average, not the median. Your salary, your multiple. If you're behind that number, quantify the gap precisely and model what closing it requires in annual contribution rate. One specific number you need to change. Not a general intention to save more. Second, stress test your 20-year runway assumption. Health problems, layoffs, and caregiving responsibilities together account for roughly 59% of retirements. More than half of Americans don't get to retire on their chosen schedule. If you are 45 and your plan only works if you contribute steadily until 67, you have an undiversified plan. Build a 1-year liquid buffer. Reduce your dependency on the assumption of uninterrupted income. The buffer isn't a savings drag. It's the insurance policy against being forced to crystallize a loss at the worst possible time. Third, audit the fee stack before anything else. Index funds with expense ratios as low as 0.03 to 0.10% help preserve more of your returns. If your 401k default fund has a 1% expense ratio and you haven't looked at it in 2 years, you are paying for performance the data says you are not receiving. Switching from 1% to 0.1% is the highest yield, lowest risk move most 45-year-olds can make today. And it takes about 40 minutes to execute. Lazy investing built more fortune than crypto memes. The math on that has been confirmed. The people who outperformed over the last 30 years were mostly not the traders, not the market timers, not the people on Reddit at 2 in the morning. They were the people who picked a low-cost index fund, automated their contributions, ignored the noise, and did something else with their lives. The boring system beats the exciting one. Not sometimes, consistently. And the biggest obstacles to executing the boring system are not external, they're psychological. The panic sell in March of 2020. The contribution pause when the market dropped 40% in 2008. The fund switch into something safer right before the recovery. The real alpha at 45 is knowing that your own decision-making in moments of stress is your largest financial risk and building a system that doesn't give you the option to sabotage it. Americans in their 40s have an average retirement savings balance of $593,109, but the median is $220,919. For Federal Reserve data, specifically on the 45 to 54 bracket, the average is $313,220, and the median is $115,000. About 62% of households in that group have retirement holdings at all. Over half of American households report having no dedicated retirement savings. About 3 in 5 American workers say their retirement savings are behind where they should be. Fidelity's benchmark: 3 times your salary by 40, 6 times by 50, meaning roughly 4 times at 45. 70% of the sandwich generation says dual caregiving has significantly affected their retirement plans, and 59% have reduced or stopped contributing to retirement savings. 59% of retirements are involuntary. 15-year consistent savers average $617,000, $600 more than 4 times the overall average. The numbers are uncomfortable, but they are workable if you use them as inputs rather than scorecards.